let's dig into those direct investments a bit more, which sit on your balance sheet. Appreciate they're not part of the long-term plan anymore, but they're significant, particularly in terms of short and medium-term shareholder returns. I've emphasised in my research notes the share price is nowhere close to reflecting the value of those. The latest NAV is £125 million. The market cap of the entire business is only about 116 the last I looked. So one step at a time. Give us a short overview of what that portfolio consists of, the types of businesses and where they are in their life cycle.
Absolutely. So I'll give you a snapshot across some of them. I think contextually as well, I'm always a big fan of the context behind everything. So often being told, control what you can control and what you can't control. Try not to get defocused, try not to get distracted by it. We can't control the share price. And the share price is driven predominantly by a general capital outflow that's going on in AIM. So what we do is we focus on maximising value within Mercia, and the markets are the markets, and that's how it is. But the one thing to reassure markets is our balance sheet. And of course, we're not going to suddenly sell them all next week, because we're not in fire sale territory. There is nothing on fire in our balance sheet. We are pragmatically developing those through to exit. Our balance sheet assets have all been, we have advisors, sector advisors across them all. We know those value inflection points, what we're trying to get those through. So what we are going to do going forwards through regulatory and through general sort of public awareness is shine a spotlight on each of these assets that are developing through, because we've got some very high profile businesses coming through, whether it's Medherron with its testosterone patch, where it's under development and under delivery through clinical trials at the moment, whether it's Warwick Acoustics for its fantastic flat speaker technology, which is integrated into an automotive, which we hope to be sharing the name of that automotive in the coming period, short period.
Okay,
so that will be coming through, whether it's VoxPopMe, our video analytics business in revenue growth with a very sophisticated AI engine built into that. There is a multitude of different businesses going across, and what we have to do is not just sell them, because of course we're going to do that, but tell people out there what they're about, so people can understand why we believe the holding value is right, and maybe others don't. So there's an education in that regard. But in terms of our portfolio, we've got about 20 direct investments. We've not been adding new direct investments now for quite some years. So it's a focused portfolio in that regard. Of those 20, about 80% of the total portfolio value is captured in the top 10. So clearly those top 10 are really important. And within the top 10 are names I've just mentioned. So they sit within the top 10. There are others that will be driving value through, but that is the main focus within our efforts in terms of value realisation, is those top 10.
Right. And Mark, what's the exit environment like at the minute? What would those exits look like, and how are you working with management to engineer those exits?
So when we set out on this strategic plan, this 3-year plan, we spoke to co-investors, we spoke to management, so we had to make sure there was an alignment here, because you don't want to force a sale. You want a pragmatic realisation from this, and you're looking at a sort of value maximisation. I mean, our commitment to the market is, look, the holding value will realise from that. But I would like to think that Warwick Acoustics will go for much more than the holding value, for instance, because it's a very exciting asset. So we are aligned in that regard with all. We're absolutely all. And back to that sort of beginning purpose, this is about wealth creation and prosperity, and for all our stakeholders, which includes our funds and our balance sheet. Now, if you look at our direct investments, almost all of those have fund investments alongside them, because they have originated from the funds. So that alignment is really, really critical. And so we're quite proud of that. And we have within our venture portfolio, we sit on the boards of them all. We have a very strong relationship with our co-funders and with the management teams that are driving those, who are frankly working 24/7 to maximise value in those businesses. And that's important for us, because a lot of the investments we make are into repeat entrepreneurs, into NEDs that we sit on the board. So behaviour is really important in our game. So we have full alignment. We're moving those through. In terms of the exit environment, the notable thing is the IPO market is very subdued. I mean, very subdued. And we often hear in the press about the public markets are going gangbusters. Look at the FTSE 100. FTSE 100 is a sort of global index of what's going on. Go below that. Look at the small cap market. And the small cap market, whether it's on the main market, whether it's on AIM, is struggling. And therefore, the attractiveness for an entrepreneur to take a business onto what would be a suppressed valuation is less interesting. So what we're finding with our venture businesses that occupy in the private markets is that we've got secondaries, we've got larger funds that are taking positions out in them, and we have trade sales, which are predominantly overseas corporates.
Right.
And so, stepping back on my own personal passion, which is to get the UK working region by region and to keep businesses here and to grow them, then we need a public market functioning. We need the small cap market functioning. And so that is a piece that until that starts working, our exits are driven by secondaries and by private sales, whether we like it or not.
Yeah.
And that environment at the moment is still actually very buoyant. The one feature that's happening in that market is transactions are just taking longer. So exits take longer, engagement with acquirers takes longer, the whole process is lengthened, and that's not a Mercia, that's an industry-wide perspective at the moment, is both transactions in terms of getting into these businesses and in terms of getting out of the businesses takes longer.
Yeah. Last one on the direct investments. You touched on the exit track record in terms of valuation. That's the easy answer on how you value these, and what's the potential for that to be too aggressive or too conservative even?
Not too aggressive, because that is the one thing you'll get absolutely burnt with. But there's a real balancing act, because you can't also be too conservative. Because it's not, especially as a listed business.
Yeah.
Within the private context, less of an issue, because you don't have the dynamic of buyers and sellers always going
Right.
on. You've got your LPs locked in a long-term fund. If you've got the valuation wrong or right at any one point, it will correct through. And if you don't deliver the returns that they expect, that's your last fund you're managing on their behalf.
Right, yeah.
So within the private market, it's a slightly different dynamic. Within the public market, you have to get the valuation right, because if it's undervalued, then you're selling short of the existing shareholders when new ones are coming in. And if it's overvalued, you have the polar opposite challenge. Yeah. And we follow very clear regulations in terms of the International Private Equity Valuation Guidelines. Very clear sort of draw on how you value these businesses, often through multiple metrics in terms of trading fundamentals, in terms of comparators, etc. And we do independent valuations. And I think the other thing is, although we don't need to, we have our balance sheet portfolio audited every 6 months. So a third-party adjudicator, if you like, will look across those and determine whether we're right or not. And we'll report publicly against, we think you've overdone this or you've underdone that. And it's all in the public domain, and people can see what third-party auditors think about that. I think that's a really important metric. Ultimately, it's whatever you sell it for is what the value is. And what we have to do is make sure it's the right value.